How is everyone doing? Welcome back to another episode of The Banker Next Door. I am your host, Dr. Joe Berquist. Today, we're going to be examining commercial real estate. I'm going to be getting everybody an update on kind of what is happening right now in the moment. And we're going to look at a couple of specific things. We're going to talk about, and I want everybody to hang around until the end because we're going to talk about the commercial maturity wall. That's going to be the big thing for the end here. But we're also going to look at a couple other things. We're going to look at how is U.S. commercial real estate affecting German banks' assets. We're also going to look at community banks. How is commercial real estate kind of testing community banks' earnings, and what are we seeing of that? We're going to talk about some precautionary things precautionary measures, if you will, that banks can take when trying to deal with their commercial real estate portfolios. And then we're also going to take a look at kind of the commercial real estate backlash in a way. Like, in other words, should banks be increasing their loan loss reserves as it relates to commercial real estate right now? We're going to be looking at 5 different articles. So without further ado, let's jump into a couple of them here. So the first thing I want to look at is this is the PCBB. This is their daily newsletter. And this one is entitled Rising Commercial Real Estate Risks Loom Within the Banking Industry. And so they talk about the rising risks. And one of the things I wanted to read to everybody here was it says, according to the Mortgage Bankers Association, the MBA, the value of outstanding commercial real estate loans totals roughly $4.7 trillion, approximately $2 trillion of which is expected to mature by the end of 2026. Now, we're going to talk about that a little bit more in depth in a few minutes when we get to the commercial maturity wall. So hang tight for that. So office space comprises a large portion of loans nearing maturity, but multifamily housing also accounts for a major percentage, an area where building owners face their own set of challenges in certain parts of the country, with cities such as San Francisco and New York City implementing regulations that limit rate hikes on certain types of apartment buildings just prior to the pandemic. Regulation put in place amidst record low interest rates, many of these owners have been struggling to make loan payments for the past few years. Given the factors above, financial institutions, which hold roughly 38% of all outstanding CRE loans, have tightened CRE lending standards over the past year at the highest rate outside of a recession. In the fourth quarter of 2023, 67% of loan institutions increased lending standards for non-residential loans, and 65% did so for multifamily loans. So, and then this goes on to say heightened scrutiny and skepticism. Following last year's bank failures, regulators have heightened their scrutiny of financial institutions' CRE holdings, and increased skepticism abounds. Though non-performing commercial real estate loans doubled in 2023 to 0.18%, up from a paltry 0.4% in 2022, it is believed the numbers may actually be higher. Analysts suspect that many financial institutions have been granting short-term maturity extensions for some of the CRE loans in their portfolio to give borrowers more time, a practice that is known as extend and pretend. As a result of this practice, analysts at PGIM Real Estate say CRE maturities in 2024 rose 35% above previous estimates, while analysts from Autonomous Research estimate roughly 40% of the commercial real estate loans maturing in 2024 should have matured in 2023. That's a pretty high percentage. That means a lot of loans from 2023 got pushed into 2024. And as we approach September here, we're probably going to get pushed out into 2025. So now, what are some precautionary measures that banks can take? So, stress testing can do more for your institution than just identify loans that may default. Routine stress tests on your portfolio can also help you to quickly assess impact under multiple scenarios, calculate potential losses within a variety of economic environments, perform those calculations within the parameters of current reserves and forward earnings, and provide strategies for how to move forward with problematic loans in your CRE portfolio and beyond. Once your team has a better idea of what risks could be hiding within your CRE loan portfolio, the strategies for addressing that risk can be incorporated into your risk management processes, which may or may not include unloading or other methods to avoid any potential loan defaults. So, stress testing can be a good way, but I think that there is something even better, and that is just a good old-fashioned methodical loan review. I think if you're a bank that has a huge commercial real estate portfolio, you should start to break that portfolio down by subgroups. Like what, maybe loans $1 million and under. Looking at the different categories, how much do we have? How much industrial, multifamily, office, retail? And I would probably attack the office first and basically say, okay, let's take a look at every office property that we have and what do they look like? Let's break it down. Let's try to get some current information. Let's make sure that rent rolls are current, leases are current. Let's take a look at expenses. Maybe try to understand. Maybe do some shock analysis there. Like maybe try to understand if property taxes are going to increase, if insurance policies are going to increase, which they pretty much have across the board, and just understand how those higher expenses are ultimately going to affect the cash flow on any given individual property. So I think trying to look at that type of information on each property as best you can to try to figure out, like, okay, is there something that could potentially be a problem, or is everything just okay? So we got that. Now let's jump into, this is an article from Bank Director called "Bracing for a CRE Backlash. As COVID era CRE loans come due, banks should prepare to replace potential losses." So this gets into, what's the worst that could happen, what can be done, and then basically what's the bottom line. So let's say, what's the worst that could happen? So we've seen this one before. If rates remain elevated with this volume and exposure by commercial lenders, the impact on financial institutions of all sizes could be significant. With multiple factors impacting borrowers' ability to repay, banks face higher default rates, leaving them stuck with bad assets that may need to be written off, along with collateral that will likely have to be sold at a loss. If enough banks find themselves in this position, it could catalyze consumers to start pulling deposits and depleting liquidity, potentially causing bank failures. Based on the impact of just Silicon Valley Bank, Signature Bank, and First Republic Bank failing in the spring of 2023, we know that a run on banks is possible and would be catastrophic, not only for the financial services industry, but also for the economy as a whole. So, there is some truth to that. I don't know if I fully agree with that, because does correlation equal causation in that scenario? I don't know. I don't know that does. I mean, I don't know that commercial real estate loans going bad is going to lead to, that was not the issue at Signature Bank, at Silicon Valley Bank. Like, yeah, like they did have some issues in their commercial real estate portfolio, but that was not what caused the run on those banks. That was caused by, a large amount of uninsured deposits, their relationship with crypto, the unrealized losses they had in their bond portfolios, which were massive. I mean, those were the real things that basically began that liquidity crunch and what caused the run on those banks. So, but let's keep going here. Like, what can be done? So they should review the appetite for these services among their commercial clients and determine if new services should be added, or if pricing on existing offerings should be adjusted based the increased value of the services being offered and customer demand. Yeah. So, and then let's go back to the main kind of the beginning point here. So banks need to prepare now for potential losses by reviewing current and potential revenue streams. They should review current pricing on existing products and explore products that will drive the most revenue and generate deposits the quickest with the lowest cost and shortest implementation time. So, so that, again, now you're getting into kind of, again, more of a deposit conversation, like what kind of depository products are you offering? Are banks going to have to begin to get more dependent on CDs as opposed to business checking accounts, which are, which can be non-interest bearing. So yeah, I'm not sure if but then it says basically, like, what's the bottom line here? The full impact of inflation, Higher interest rates, low liquidity, and increased concentrations is about to rear its head. Banks need to be prepared, but they need to be thoughtful and really consider their customers' needs when it comes to identifying the right sources of stability and growth. With thoughtfulness and planning, it is possible for banks to collect more income from customers and replace potential losses while showcasing increased value and maintaining loyalty to their bank by offering new, easy to implement, useful, and convenient services. So, yeah, I mean, I think the bigger question here is, have banks reserved enough money for potential losses from commercial real estate? Not necessarily, you know, um, analyzing customer needs and identifying the right sources of stability and growth. Like, I think we're just back more toward like an age old, the credit quality of your loan portfolio, and if you're very heavy on commercial real estate, what does that mean for you? It's not necessarily a bad thing, as we're going to see here in a second. So let's jump in now to some S&P Global Market Intelligence articles. So here is community banks. Let's talk community banks for a second. So community bank earnings tested, but not crushed by commercial real estate. So community bank margins are poised to rise, but higher loan losses and reserve builds to cover them will stand in the face of earnings growth. While funding cost pressures have likely peaked, again, getting back to the depository, institutions could still feel pain from customer balances repricing at current market rates when certificates of deposits mature, absent notable declines in interest rates, which some market watchers expect given recent weaknesses in unemployment trends. Deposit costs are unlikely to drop significantly in the near future, but net interest margins should still expand as fixed rate assets reprice at higher rates. In other words, the repricing of commercial real estate loans. Some of those assets will not find lenders willing to refinance the credits, particularly in the commercial real estate segment, leading to higher loan losses. Community banks will incur some of that pain, but the loss content will not match the fears of some investors who believe the credit deterioration will claim scores, if not hundreds of banks. So, and then we've got some community bank metrics here. We've got efficiency ratio, net interest margin, return on assets, like return on assets equity, year over year earnings growth. So we can see there that basically, for the first quarter of 2024, which is actual, and then we have 2024 projected. So you can see their efficiency ratio, 63.98, still fine. Net interest margin of 3.34, still okay. Return on assets, 1.09, still okay. Return on equity, 10.81, still okay. Year over year earnings growth is negative 3.8, and that's the actual number. Projected is 10.5 by the end of the year. So we can just see here in these numbers that, like, so far, commercial real estate is, again, there's some issues there, but it's not doing anything. It has not materialized as of yet that it's doing anything that's dramatically impacting the financials of community banks. And then it says here, community banks nearing peak funding costs. Deposits have remained firmly in focus for community banks, even though liquidity pressures are not as acute as they were in 2023. Community bank deposit costs getting more competitive with market rates, and we can see that CDs continue to be there. Net interest margin under pressure as funding costs rise. And then let's see. Let's skip over to the next one. Now let's look at souring U.S. commercial real estate loans hit German banks' asset quality in Q2. And here's where we begin to see kind of the difference in the commercial real estate segments that we're talking about here. So U.S. commercial property remains a drag on the asset quality of exposed German lenders, which flagged more problem loans related to the sector over the second quarter of 2024. Specialist commercial real estate lenders, Ariel Bank and Deutsche PF and Brief Bank, I'll say PBB, as well as Germany's largest lender, Deutsche Bank, said their exposure to U.S. office properties in particular is an ongoing concern amid high vacancy rates and declining valuations. In the second quarter, all three banks saw problem loans as a share of gross loans increase from the previous 3 months as well as from a year ago, according to S&P Global Market Intelligence. And then you can see here kind of the rate of problem loans right here shooting up. U.S. CRE takes up the largest share of property non-performing loans, NPLs, at Ariel Bank and PBB, and has accounted for over a quarter of Deutsche Bank's credit loss provisions since late 2023. Now, I think you got to look at here, what are and this is the big thing, what are the types of commercial real estate? So in other words, these big German banks, they're financing big office towers in U.S. cities here in the U.S. Like they're financing the 10-story, the 15, the 20-story, the 30-story office building in downtown markets like San Francisco and New York and Philly and Chicago, and major cities. That's the type of commercial real estate that they're financing. A lot of the commercial real estate, and I'm just kind of skimming through here, a lot of the commercial real estate that you're seeing with a lot of these banks, again, it's the big office towers in the urban settings. That's where the big problem lies. When you go back to the community banks, a lot of the commercial real estate that they have on their books, it's smaller commercial real estate. It's small, 5 to 10 unit apartment buildings. It's mom and pop strip, retail strip centers that might have 4 or 5 units in it. It's smaller, 2-story office buildings that might have just, 2 tenants, one on the first floor, one on the second floor. The building might be 20,000 square feet. Like, a lot of owner occupied commercial real estate, which is not seen anywhere near the type of pressure that investment real estate has seen. And so I think that is one of the major differences here when you begin to dig in to these different segments here of commercial real estate. And you can see how it's kind of affecting or not affecting, different size banks and different types of segments here. So, and again, but this is also an interesting thing, because you might be asking, well, why haven't we, if there's a lot of delinquency in these center city urban areas, why have we not seen it with U.S. banks? And the reason is because a lot of those loans have actually gone to overseas banks. They've gone to German banks. They've gone to Japanese banks. A lot of them have stepped in and picked off a lot of these loans. And they're suffering with it, but that's why you're not seeing it with some of the U.S. banks. So now let's talk about the big thing here, and this is what I started out with at the beginning, and that is what's called the commercial real estate maturity wall. And right now in 2024, that is approximately $950 billion. But this article basically says that this is going to peak by 2027. So rate hikes by Federal Reserve and changes in post-pandemic behavior have put pressure on commercial real estate borrowers needing to refinance loans coming due. The tally is nothing to sneeze at, with approximately $950 billion in commercial real estate set to mature in 2024. And then you could kind of see here from this chart the maturities here. So we could see we're here in 2024. We're at 946 billion. Get the next year 998 billion, 1.148 trillion, and then 1.257 trillion before it starts to come down just a little bit, still over $1 trillion in 2028. So a lot of commercial real estate there maturing. And what we talked about a few minutes ago was the extend and pretend, where a lot of the loans that matured in 23 got pushed into this year. And now we're probably seeing loans from this year getting pushed into next year. So it said, basically, and this goes on to say here, should borrowers fail to seek the necessary refinancing and default on their loans, banks would not only face losses on their loans, but valuations in the CRE market could come under significant pressure. Origination data shows that maturity wall will grow to nearly $1 trillion in 2025 and ultimately peak in 2027 at $1.26 trillion, suggesting that the issue is unlikely to resolve soon. Even with interest rate reductions. So let's see here. And it goes on to say the Federal Reserve's interest rate hikes since March of 2022 have put pressure on borrowers that need to refinance CRE loans coming due. To measure the potential interest rate shock for borrowers, we looked at the average interest rate on CRE loans originated in 2024, which was 6.2% versus the rate on mortgages maturing, which is at 4.3%, a jump of nearly 200 basis points or 2%, which is that's a big shock. Should borrowers default on loans, it would not only lead to losses for lenders, but could add downward pressure on CRE prices. Based on our estimates, we expect approximately $950 billion of commercial real estate mortgages to mature in 2024 and higher totals in the 4 years after that. In the next 5 years, we expect the amount to peak in 2027. All of the different CRE categories, the office sector is being closely watched as the shift to more employees working remotely post-pandemic has led to elevated vacancies and delinquencies in that space. Approximately 10% of the CRE mortgages maturing in 2024 are office properties, based on our analysis, which is higher than in 2023. But on the bright side for lenders, we expect the ratio to decline in subsequent years. We expect a modest increase around 6% in CRE mortgages coming due from 2024 to 2025, but 2026 should be a much tougher year as we predict the total will rise to 15%. And it bears noting that many CRE loans set to mature in 2024 will be extended to 2025 and beyond, as bank regulators are allowing lenders to work with borrowers rather than forced maturity. Extensions could provide borrowers some cover in the short term, as well as give lenders time to work out troubled credits and selectively prune their commercial real estate portfolios through strategic sales in the secondary market, i.e. private credit. And what I reported on, in episodes previously about how, bigger banks basically dumping their commercial real estate loans. But some borrowers could need rates to move notably lower for refinancing to be viable. And here you see here kind of the interest rate shock. And then we kind of come down here. Commercial real estate mortgage spreads have widened in recent months. Again, roughly 10% of commercial real estate mortgages estimated to mature in 2024 are office properties. And then it just kind of wraps up with kind of like some of the methodology and stuff that they looked at. So this right here, this commercial real estate wall, this is a big thing, and I should note that aside from just commercial office properties, I mean, apartment buildings are not safe here either. I mean, I think you're going to see not anywhere near as much trouble, but I think you could see some trouble in the apartment property sector, because as property taxes increase, insurance increase, your expenses are going up, utilities continue to go up. That puts more pressure on landlords in the multifamily space. And if they basically have to refinance into this interest rate shock, going up to basically 200 basis points, that's gonna have a big impact on their cash flow. And we could see some trouble or some a little bit of issue there with the apartment properties. But we'll see what happens. But anyway, I tried to put this episode together. I thought people would find this interesting, kind of looking at the commercial real estate from a number of different aspects in terms of, what can banks do to try to ease this burden? What are we really looking at here with the wall of maturity coming up, and the question of, do banks have enough loan loss provisions? Do banks, as far as banks' funding source for trying to do new loans, trying to refinance existing loans, the deposit base and what that means if loans start to go bad, how the U.S. property market's affecting German banks, because they've done a lot of these, bigger office properties in urban centers. So again, I thought there's just a lot of interesting things to look at, a lot of things going on here in the commercial real estate space. But with that, I will basically wrap this episode up. So if you like this episode, please make sure to like, share, and subscribe, as that always helps the channel. Please make sure tomorrow night, I will be on Podbean doing a live stream live at 6:30 p.m. That's Eastern Standard Time. And I will be on YouTube at 8 o'clock tomorrow night doing my weekly strategy room live stream. And again, that just brings you all kind of like the weekly news of the week with banking. I try to share with you guys interesting stories, interesting things that are going on in the world of banking. So please make sure to check out those live streams tomorrow night if you get a chance. And then I will have probably at least 3 or 4 episodes coming out on Saturday. So probably 2 episodes Saturday, 2 episodes on Sunday, and then I'll have and then there'll be more episodes coming out next week. So keep an eye on more stuff coming up. But like I said, hopefully you enjoyed this video, and I will see everybody again real soon. Thanks a lot.